Hello, dear friends. I'm Sunil Shah on behalf of Axis Securities research team. We all know that the budget is behind us. The long-term capital gains tax is again back in the market. The result season has got over, and we are seeing the markets pretty volatile at this juncture. So I'll take some minutes of yours and I'll share my thoughts on what I think is relevant in this market at this point in time. I will also share some stocks or some ideas which I think can be interesting from investment point of view. So I'll take you through my presentation and touch upon the key points which I think are very relevant at this point in time. So with that, let me begin my presentation.
Market, if we see the markets in the last 2 months, more or less it has been in a range. But if we see the mid caps and the small cap stocks, there is some amount of correction in stock prices which has happened. So let's understand why that is very critical, because most of the portfolios which the investors have are in the small and the mid cap category. So there is a directive which has come from SEBI, which has been addressed to mutual funds, saying that in case of mutual funds, they cannot have multiple schemes in the same category. What it means is, if they are calling something as large cap, then they have to have only one scheme in large cap. In mid cap, they can have one scheme. In small cap, they can have one scheme. So you cannot have multiple schemes in the same category of large, mid, or small. And at the same time, if you are calling the scheme as a large cap scheme in mutual funds, you need to be invested in top 100 stocks. So far, what was happening is that every mutual fund was defining their criteria of large caps. So some would say that we would call large caps as companies with a market cap of more than 10,000 crores. Some would say that we'll call large cap as companies with a market cap of more than 20,000 crores. So there was no standard definition of what a large cap is. What SEBI has done is that they have categorized that the top 100 companies by in the order of market cap. The top 100 would be the large cap companies. Companies which are from 101 to 250 in their ranking would be mid cap companies, and anything beyond 250 would be categorized as small cap companies. And SEBI has also directed that by 31st of March, you need to realign all your holdings of companies in these three categories. So what it means is that every mutual fund, if it was a large cap company and it was holding any of the mid cap stocks, they had to sell the mid cap stock. So if it was a large cap fund, they were allowed to invest between 65 to 85% of their holding into large cap. But it cannot be that you hold 50% mid cap stocks and you call yourself as large cap fund. So what it means is that there was realignment of stocks within mutual fund, and that is why we have seen that many of the mid cap companies corrected big time, and many of the large cap companies, despite them not showing growth of profits, were actually purchased by the mutual fund managers. So that realignment is going on in the markets, and the time period which SEBI has given is up to 31st of March 2018. So that's a window of 3 months in which this entire realignment has to happen. So what was happening is, either funds are buying or selling, or they are uh, clubbing various schemes. By clubbing the schemes, it means two, three schemes which are having different parameters are merged into as one scheme, or they are reclassified as a multi-cap scheme. By multi-cap scheme, it means they can invest in any category. So they are redefining their schemes wherever it is possible, and where it is not possible, they are actually selling in the markets and buying what they are supposed to buy. So if you look at the next slide, and in which I'll just highlight the data points, which is, if you see the large cap fund in the second column was supposed to be at something around 4 lakh odd crores, but the actual holding which was there was something like 5.63 lakh crores. So I've just highlighted that they were supposed to hold 4 lakh crores worth of large cap stocks, but their holding was 5.63. And in this category of 5.63, there were a lot of mid cap companies which they were forced to sell. So what happened was, what they were holding was not large cap but mid cap, and so that is where we have seen selling pressure come in. And this is where understanding how the liquidity behaves in the market is extremely important. Now, mutual fund participants have become a big stakeholder in various companies, and their buying and selling decides the direction of the stock prices. So now we are in a zone in the market where we have to understand liquidity, because many of the things are even beyond understanding of valuation. So it's not a comfort zone in which valuations are attractive and you could go and buy any stock and you would make money. So it's extremely important that we understand liquidity, and that is where we have highlighted what they were supposed to hold versus what they were holding in the all the three categories of large cap, mid cap, small cap. And now that realignment is going on. So net net, if you see the gross total, it is 9,13,000 crores in both the categories. But if they are holding anything excess, this is where I highlighted in the slide, which helps us to understand what is happening in the market. So this is beyond budget, this is beyond long term capital gains. It's about understanding the pattern of liquidity of the mutual fund holders. Another graph also depicts exactly what I'm trying to say here. In this graph, we have looked at normalized data. By normalized data, I mean we have kept everything as 100 on one particular date and seen how it has behaved over a period of time. So the graph on the left hand side is where we have taken 1st January 2017 as a cutoff date, and we have plotted three indices. The blue index or the blue line is the BSE Sensex, the red one is the Nifty Mid Cap 100, and the green one is the small cap index. So if you see the normalized thing, that's from January 2017, Sensex, which was 100, has gone up to 125, mid cap has gone up from 100 to 135, and the small cap has gone up from 100 to 147, which means the small cap and the mid cap actually did much better than the Sensex or the large cap universe from January 1st, 2017 till January end 2018. But if we just look the data for from 1st of Jan 2018, you can actually see that the Sensex, which is again the blue line, is almost flat to positive, but the mid and the small cap stocks are actually trading anywhere between 8 to 10% lower. This brings out the point which I mentioned in the earlier slide, that the large cap is the one where the fund managers have to be invested, and the mid and small is compulsory sell for them. So the pattern which is there in terms of long period of time of 12 to 15 months indicates that the mid and small were doing well. But if you look at the regulation which SEBI has bought from 1st of Jan, things are quite different. And according to us, this is more of a cyclical factor. By cyclical factor, it means that it is a temporary aberration and things move in cycles and then they wade off or it ends. But if anything is very much structural, it stays for a long period of time. So in this category, we think that this is more of a cyclical phenomena, and thereafter again we will see that sanity will prevail and money will flow where earnings growth are strong. So eventually it will be this category which will do well. This is another slide for us to understand how the market is behaving. So this is a lot of numbers here, and I'll try to simplify it as much as possible. So I'll try and highlight the numbers which are important for us to know. So the first three columns, I have plotted the actual number of the Sensex, the mid cap index, and the small cap index. Now in this table or chart, if I look at the historical data on Jan 2004, this were the three actual numbers of the indices at that point in time. Whereas in the market gained the top in January of 2008, that is when the Sensex went up to 21,000 levels, up from almost 6,000 in 2004. The mid cap index rallied to 10,000 and the small cap index actually rallied to 14,000. Uh, Thereafter, right now as we are speaking, these are the numbers, which is 34,000, 16,000 and 17,000 on the Sensex. Now if we normalize again the same thing, we'll come at this graph here, which says that in January of 2008, when the top of the market happened, the rally had actually been from in the ratio of large cap, mid cap and small cap in the ratio of 1 is to 1.18 is to 1.6, which means that whenever the bull market happens, the small and the mid cap stocks actually run way ahead of the large cap stocks. And that is when the correction creeps in. So when we see it in January of 2008, the Sensex, if it was 350, the mid cap index came at 420 and the small cap came at 570. Now that ratio is shown here, which is 1 is to 1.8 is to 1.6, which means if Sensex was 1, mid cap index was 18% higher than the relative performance of Sensex. Sorry. And the small cap index was actually 60% higher than the large cap index. So when the top in the market happens, or when the actual euphoric zone comes in, it is a small cap index which really rallies way ahead of the large cap index. Now today when we are talking, that same number of Sensex versus the mid and the small cap is what it is shown here. So the top of the market will actually happen when the small cap index of 1.2 inches past beyond 1.6 or so. So since that is not happening, it gives us a comfort that market is still got a lot of steam before which the irrational exuberance creeps in the market. Again, let's understand the liquidity factor. As I mentioned, it is more to do with the mutual fund flows. And right now, as we see in the last year of 2017, huge liquidity was pumped by almost every domestic investor in the market. The category through which flows came in the market were multifold, meaning SIP was clearly a case in point. There were also EPFOs, which was Employee Provident Fund. An Employee Provident Fund was mandated by the government to invest a portion of their corpus into the equity markets. Now in this year, that percentage has increased to beyond 15%. And so we'll see a flow from EPFO, which had been at about 13,000 crores last year, can go up to as much as 30,000 crores in this year. Again, there is this NPS which has been allowed to invest into equity markets. There is omnipresent, LIC which is there. There is ELSS which is now considered at par in terms of tax savings. And the flow of money which will come from ELSS is expected to be 80,000 crores versus 50,000 crores. So all put together, this year alone we will see almost about 2,40,000 crores plus of money come from various investors into the equity market, from 1,57,000 crores last year. So almost about 1,50,000 crores is expected to be upwards of 2,40,000 crores this year. Now let us look at this in context with the FII flows. FII is nothing but the foreign institutional investors. Those are the global investors who invest in our equity markets. And this FII flows have been always erratic. The FII flows are more or less dependent on a lot of global events. So whenever anything globally becomes good or bad, that decides the allocation of global flows into emerging markets like India. Now, if I look at the data of FII flows for the last 6-7 years, I can see that the number or the amount of money from FIIs has been a high of 1,30,000 crores to something around 18,000 crores. So it's been a range, or the amount of money has been significantly varied. Now, if I look at this amount of 2,50,000 crores from Indian investors into equity markets, it is almost 2x or very close to 2x of the highest ever FII flows. What it means is that Indian market is not dependent on FII flows or any event globally. So even if interest rates are rising in US, it does not mean that Indian markets need to be worried about any longer. The reason is clearly because even if interest rates are rising and FIIs are not optimistic on Indian markets, we have the cushion of money from Indian investors huge enough to protect the markets from wild swings. So again, this means that Indian markets have technically got their independence from the FIIs at this point in time. So Indian market is now independent of FII flows. It means that even if foreign flows are positive or negative, Indian investor need not worry because there is huge amount of buying power which is there in the hands of Indian investor itself. So this is one very, very important point, and this is all publicly available information in terms of SIPs or EPFOs or ULIPs or ELSs, and you just have to collate the kind of total addition, and this is what you come at. This again is giving an indication of the strength of the FIIs, which is actually reducing over a period of time, and it is the Indian investor who is actually owning the equity after a long period of time. And to my mind, this has happened for the first time ever that all other asset classes avenue for the investor, Indian investor, are not so positive. What it means is that for Indian investor, the available options to invest are either bank fixed deposits, which are as it is trading at very, very low rates of return of interest, or it is real estate, which is again not doing well for the last couple of years and seemingly might not do well for the next 2 years as well because of the huge supply coming in real estate. The third one is gold, which is again trading at stable prices. So the options for the Indian investors are limited, and that is what has happened for the first time, that all three alternates of gold, real estate, or bank deposits are not attractive, and so the Indian investor is investing big chunk of his surplus into the Indian equity market. So that's for the first time that all other asset classes are not so remunerative for the Indian investor. This is one very important slide. I always try to look at history, that what happened in the history is what we have to see and take our learnings from those history in the past. So it was in the year 2008 January when the Sensex had reached levels of 21,000, and in the same year of 2008, within a period of 10 months, it corrected from 21,000 to less than 8,000 in 10 months period. That was a time of Lehman crisis. And when at the top of the market, you had companies like HDFC Bank, you had Hindustan Unilever, you had Maruti, you had TCS. All this were trading at very, very low prices at that point of time. So it was more of all these stocks trading at great attractive valuations. Their businesses were very good. And in this 10-year period, when the market has moved from 2008 levels of 21,000 to current level of 33,000 on the Sensex, you can see that all these companies like HDFC have given returns of 450%. You have seen Maruti, which has given returns of 860%. So market has appreciated by just 50%, but you have pockets of stocks which have actually become 4 to 5 or even 9 times. And at the same time, the same set of companies like Reliance Communication or Reliance Infra or even DLF or BHEL, which were part of the Sensex at that point in time, all of those companies have actually depreciated or they have underperformed the market big time. So the takeaway which I want to share with all of you is that it does not matter in terms of the levels of the market. What matters is the individual company or the individual business that you are buying and how that business or company is going to pan out over the next few years. So like in this example, it was banking, FMCG, auto and IT which did extremely well. When at the same time it was companies like telecom, infra, real estate which really did not do anything in terms of their business opportunity, and so their stocks actually tanked by anywhere between 70 to 95%. So what is important is nothing but the stock selection and the business and the outlook on the business in the foreseeable future, rather than think about that markets are at all time high, whether one should go and buy or not. It is immaterial about the levels of the market, but it is very, very important about the company and the business that you buy. So if you are in the right stock, the levels of the markets do not matter at all over a long period of time. And you can pick up any 10-year period, and I think you will come at same conclusion when few companies do extremely well and few companies which actually perish over a period of time. So that is the reason why I bought out this name of the companies. The thing to understand is that the business is important rather than understanding the levels of the market. So with that, I would share few of the investable ideas that I think are going to do well over a period of time. The first thing that comes to my mind is the restructuring happening in the entire Tata Group. There are lots and lots of business houses in our country, and if we try to read the newspaper and understand, majority of the top business houses are reeling under huge amount of debt pressure. So whether you pick up companies in the steel sector, you pick up companies in the infrastructure pocket, or else you pick up companies in the telecom sector or anything, majority of the business houses are currently having huge amount of debt. It is only the Tata Group which is doing huge restructuring internally. So Tata Group today has almost about 30 companies which are listed, and they have close to 100 companies which are unlisted. Tata Group is a mammoth, is a giant, and now Mr. Chandrasekhar is assigned the responsibilities of restructuring the entire group. What it means is there are a lot of cross holdings in the Tata Group. That is, one company is holding shares of another company, and third company is holding shares of fourth company, fourth is holding of third. So there are a lot of cross holdings internally, and Tata Group or Mr. Chandrasekhar has mentioned that he is going to realign this entire group into 7 or 8 top sectors. What it means is that all the unlisted companies will eventually get merged with the listed companies, and even within listed companies there would be internal mergers with each other. So to my mind, eventually we will end up with, in the next 2 to 3 years or maybe 4 years, entire companies, when they get merged with each other in the Tata Group, you will have global size companies in the Tata Group which are listed. So IT, auto, metals, FMCG, chemicals, hospitality, all of these companies will get merged, and lot of value unlocking will happen for existing shareholders. So again, instead of penning down any specific company which can do well, my idea is that if you could create a bouquet of Tata Group stocks, so if you go about buying top 10 Tata Group companies and hold it for a period of time, it could be a very, very silent outperformer rather than trying to bet on anything in terms of whether Tata Chemicals could get merged with Tata Global, or Tata Projects and Housings could get merged with Tata Power. It makes sense to go and buy each or almost the top 10 listed companies in the Tata Group and hold it as a bouquet of Tata investment. So if you are wanting to allocate a certain percentage, I think this is one group to bet upon in terms of huge value unlocking which can happen over the next 3 4 years for value investors. And the management is extremely credible. So at high valuations in the market, it is always better to buy good management and good businesses. So that is one recommendation from our side in terms of investment into Tata Group. The second company that we like is in terms of Bajaj Auto. Bajaj Auto is also now focusing more on the exports. In fact, exports will grow at more than approximately 12% of its business by next year or so. There have been a lot of permit issues in terms of three-wheelers which have been removed now. So the three-wheeler where the Bajaj Auto has more than 90% market share will continue to do well, and we expect that the volumes would grow at a good rate. So Bajaj Auto has got debt-free balance sheet. It has got cash on its books. It is being run by extremely strong management. The valuations are also modest, and so that is another company that we think will do well for investors over a period of time. The third one clearly is the space or pocket which we like in terms of insurance. But in terms of insurance, it is better to get into a Bajaj Finserv, which owns both the insurance business of the Bajaj Group as well as it owns financial stake in Bajaj Finance. So it's a financial conglomerate that you are buying if one buys into Bajaj Finserv. And insurance is an extremely underpenetrated business in our country. It is run by Bajaj Group. It is a dominant player, as well as the advantage of Bajaj Finance also flows into Finserv. So we think that Bajaj Finserv is one good opportunity to invest in the markets. Lastly, one idea which we really like is HDFC Standard Life. HDFC Standard Life is again run by the HDFC Group, the most impeccable track record oriented management. They have one of the best ratios in the insurance business as of today. They have a track record of delivering. They have a very, very healthy balance sheet. In fact, their growth on new business is the highest in the industry. They have a solvency ratio of more than 191%. So it's one of the great stocks to sip into from a long period of time. So we like this business as well. So as I stated, these are few of the ideas to invest in. We need not be unduly worried on the market levels, as I illustrated earlier, that it is the businesses that you buy which is important. And so we are recommending Bajaj Auto, Bajaj Finserv, HDFC Standard Life, and the entire Tata Group. These are all companies run by very, very great management, and these are some companies that you can invest into the markets. Well, the budget is behind us, the long term capital gains is in, the global interest cycle is on upswing, so we could see FII flows tepid in the year to come, but that would be more than compensated by huge amount of flows from the domestic investors. So that makes us optimist on the market, and that is what I wanted to share with you in a 20-minute session.
So thank you very much for the listening. Hope this was useful to all of you. Well, we have tried to do our best to share our thoughts. So we look forward to interacting very, very soon with all of you. And if you have anything to suggest or offer your comments, feel absolutely free to reach out to you, and we shall get back to you as and when time permits from our side. So thank you very much, and I will sign off from here. Thanks and bye.